Hello everyone. In my previous videos, we have discussed in detail about the various profitability elements and various profitability ratios. We have discussed about the gross profit, operating profit, EBIT, EBITDA, net profit. We have discussed about the earnings related ratios, dividend related ratios. We have discussed about the PE ratios and all. In this video, we are going to discuss about one other important element or another important profitability ratio, which is ROCE, which is also called as ROCE, which is also called as return on capital employed. So in this video, we'll discuss in detail about it, what is its formula, how do we analyze it, and how do we interpret it, how we can draw conclusion from this for whether you are a financial analyst or whether you are an investor. So what conclusion we can draw from it. So we'll understand all about that. And guys, if you are watching my video continuously and if you like my content, so please like and subscribe the channel, and please provide your comments so about the videos, and also any improvement which you would like me to have in the videos. And also if there's any topic which you want me to explain, you can provide in the comment section also, and it would mean a lot to me. Yeah, so let's start. So let's understand what is ROCE. ROCE means return on capital employed. Return on capital employed. If I talk in very basic sense, what does it show? It shows what is the return on the employed capital. What is the return I'm getting on the capital employed? Okay, it's a very basic sense, right? It shows the return which we are getting on the capital employed. So let's understand the formula first. So the formula for this is EBIT upon capital employed. EBIT upon capital employed. So basically in this there are two elements. One element is return and another element is capital employed. Yeah. So return is denoted by EBIT and capital employed is capital employed. So let's understand in detail about these elements so that we get the clarity. So what does capital employed mean? So in order to run any business, for long term, you need a funds. In order to run a business for long term, you need the fund. So capital employed means the capital which is invested in the business for long term purposes. So for long term, for running the business long term, whatever the capital you get, that is called capital employed. So when we say capital, we are not talking about only the capital means equity capital or preference capital. We talk about all the long term funds, right, which may include equity share capital, which may include the preference share capital, which may include the any kind of debt, anything, any sources, any long term sources from where you get the fund and you invest in the business, that is included in the capital employed. So capital employed is basically the capital which is invested in the business for running it for long term purposes. So any sources of funds where you get the money for long term, that is included in the capital employed. So high level equity capital and its retained earning, preferential capital, debt, that is included. So that is included in the capital employed. So the formula for getting the capital employed is basically equity plus debt. When we say equity, it means equity plus preference capital both. But it will in debt it will include all the long term sources of fund also. Any loan for long term purposes which you have taken, that will also include, right? So that we mean by capital employed. So now actually there are various formulas to calculate the capital employed, and I'm going to make a separate video especially for the capital employed because it's a very important term we should know in detail, and there are many formulas to it. So one of the formula you would see is like total asset minus current liability. Another formula would be fixed asset plus working capital. So there are different formula to calculate the capital employed, but always it will yield the same result. Now how those formulas are derived, what's the logic behind it, that is something we are going to discuss in detail in another video about the capital employed. For the purpose of this video, what you need to know is like capital employed is basically the capital which is invested in the business for long term purposes, right, for running the business and earning the profit. And since it talks about the long term, so it includes not only the equity capital, equity, retained earning, preferential capital, any debt which is for long term purposes, include everything. Okay, so that is about the capital employed. So this denominator part is clear. Now let's talk about the numerator. Numerator includes EBIT. So EBIT is basically, it's depicting or it is representing the return. So return on the capital employed. How much return I am getting on the capital employed. So now there are various profitability terms we have seen, right? We have seen gross profit, we have seen operating profit, we have seen EBIT, we have seen EBITDA, we have seen PAT, right? All these elements are there. So now why EBIT? Why not PAT, right? That's the question, for example. So the reason why we are choosing EBIT is because what we are taking in denominator. In denominator, we are taking all the long term fund, especially equity plus debt. We are taking all equity and debt, right? So since we are taking all the equity and debt, so all the returns, all the income related to the equity shareholder and debentures or debt basically also need to be included here. If you take PAT, here, then PAT only represents the equity shareholder or preference shareholders income, right? It does not include the income for debt holders, right? Debt holders income is included here, because if you take EBIT, in EBIT the income for preference shareholder, equity shareholder is also included. Since it is before interest, so debentures or debt holders interest is also, or income is also included, right? Since it is before interest, so that's why EBIT is taken here, right? So that's the reason we are using EBIT divided by capital employed. Capital employed since include everything, debt plus equity, so that's why here also in the return we need to consider the return for the debentures also, debt holders also, so that's why the EBIT is taken. So that's the formula you would see. But now sometimes there is an argument that okay, we are taking the EBIT, we understand this, i.e. interest is there which is for debenture holders, okay, and rest of the earning is for equity shareholders and the preference shareholder, but tax, this includes the tax also, right? And tax is not a earning for any equity shareholder, preference shareholder, or the debentures debt holders, right? So why we are not removing the tax? Okay, so that is an argument. So in some of the cases there is a different variant of this formula is used. In those cases, what formula is used? EBIT 1 minus T divided by capital employed. That's the formula. This is the formula is used. This is basically called as post tax, because we are minusing the tax. T means tax rate. So we minus the tax rate, so we reduce the impact or remove the impact of the tax. So basically it becomes post tax, and this is basically can be considered as pre-tax return on capital employed, right? So this is another variant which removes the impact of the tax. There is another way to calculate this, the post tax, is like you can take the PAT directly. Now PAT is basically the profit available for shareholders, equity or preference, yeah. So in this PAT you just add interest, because PAT is for shareholders, then you add the interest which is the income for the debt holders, and then divide by the capital employed. So this is again a variant, yeah. So these are different formulas. This is the formula, but this can be used as pre-tax, this is post-tax. In post-tax there are two formulas, okay. Now there is again another element that need to be considered, another thing that need to be considered. So when you talk about the profit, this is generally for a particular period, right? But when this is taken from income statement or profit and loss statement, right? So this is for the period. But the capital employed is basically taken from the balance sheet, because it consists of the equity, preferential capital, debenture, or other long-term debts, right? From the balance sheet. Balance sheet is as on date. There again there is a slight variance, you would say. This is for a period, this is as on date, right? So in order to make sure that the capital employed is taken correctly, considering what we are taking the period data in numerator, so the denominator also should be kind of an average, right? So it should not be as on date. So if given in the question, or if given the option, you should always take the average capital employed. So rather than taking the capital employed at the end of the year or period, if there is an option available, we should always take the average capital employed. So average is like opening capital employed, closing capital employed divided by 2. So that's the reason the average capital employed is preferred. So that's the overall analysis of this formula, like what this formula is, EBIT, capital employed, why it is calculated in this way, right? So I hope this part is clear. Now we'll go into the another part where we'll discuss what do we understand from this formula, and how we can use it for our investing purposes or analysis purposes. Let's understand that. Yeah. So now the first question is to understand what do we understand from it. So let me write down the formula here, and then we'll talk about this more. So the formula is, again, I'll just, for our understanding purpose, I'll write EBIT upon capital employed. EBIT upon capital employed. So let's say if a company has EBIT of 10,000 and the capital employed is, let's say, 100,000. This is generally calculated as percentage, yeah. So this will be 10% EBIT, sorry, 10% return on capital employed, ROCE. Now what do we understand from this? What interpretation we should do? Okay, so basically from this, what does ROCE suggest? It suggests how much profit company is earning, per dollar of capital. How much profit company is earning on the per dollar of capital. So it's like if I invest $1 or if I invest $100, or if the company is having $100 of capital, it will get $10 as return. Okay, because this is the capital employed and this is the return. This is the return and this is the capital employed. So return upon capital employed, it means per $1 or per $100, how much profit per $100 of capital, how much profit company is making, or the return the company is getting. So how much profit or how much return company is getting for per dollar of the capital invested. That's what this says. Okay, so basically it tells you two things. It tells you about the profitability of the company, whether company is profitable or not, or the percentage of profit, how much profit they are earning as a percentage of capital, and more importantly it tells you about the capital efficiency. What do we mean by capital efficiency? Capital efficiency means which company is able to utilize its capital more efficiently to generate the profit. Let's say this is the company A, right? And there's a company B also. And company B, with the same capital, they are earning 12,000 profit, which means 12% of return on capital employed. So when they are earning 12%, it means from the same capital they are able to generate the more profit. So they are utilizing their capital more efficiently to generate the profit, whereas this is not utilizing that efficiently to generate the profit. So this is more efficient in utilizing the capital, this is a bit less efficient in utilizing the capital. So that's what we talk about, the capital efficiency and profitability. Yeah, so that's the basically this ratio tells. Now how do we analyze it, or how do we interpret it? So when you analyze any financial ratio, right, when you look at any financial ratio, you look at the balance sheet of a company, profitability of the company, you will derive the ratio or you identify the ratio, right? But you cannot just draw the conclusion just based on that ratio for that period, right? You need to consider many things, right? You need to consider many things. First, let's just take example of this company, right? Company A, which just says, okay, for this period, let's say year, or for 1 year, they are giving you the 10%. Now what do you make of this? You cannot take a standalone conclusion, right? You need to analyze. Now how you need to analyze? First you need to analyze the trend. Okay, you need to analyze the trend. So you need to see how much historically company is earning, what's the ratio historically, right? So based on the trend, you need to analyze whether the trend is going upward, whether trend is going downwards, or trend is stable. If it is going upward, that may be good. Okay, so company is continuously using its capital more efficiently to earn the profit, so that may be good. If it's consistent, then also it may be okay. But again, I'm saying maybe because there are other factors we need to consider. And if it's going downward, that may be bad. May be bad. Again, in all cases, it's all are maybe, because there are other factors that we need to consider. I'll give you an example, right? So in this case, it may be good. It may be good because there are other things. I'll just tell you in other points also which we need to consider. But generally speaking, if you see trend, if it is going up, it may be good because they are earning more profit on their capital. If it is going smoothly, consistently, that may be okay, good thing. If it is going downwards, then it may be bad, but it may not be always bad. I'll tell you an example, right? Let's say this company, for take an example of this company, 10,000 and 1 lakh, 100,000, then 10%. Let's say in the year two, what happened? Their profit remains the same, but their capital investment or the return, capital employed become 2 lakh 200,000, and suddenly this become 5%. From 10% become 5%. Now it earlier it was 10%, now it became 5%. So this company become bad? We cannot draw the conclusion just like that. We need to understand why the capital increased but the profit remains the same. Then we can understand that company might have taken some loan, or company might have raised new capital for investment in a project, but they have not completed the investment. Okay, they have taken the loan or they have acquired the equity, but they have not invested yet. Maybe that will be invested in the upcoming year and the profit will be generated, right? So for the time being, this may have reduced. Okay, the ROCE may have reduced, but in future it may increase once the capital or the money gets invested and the profit is started generating, right? So that's how you need to see. Okay, I understand it is reduced, but you need to know the reason. Once you know the reason, then you can draw the final conclusion. Yeah. So you analyze the trend, but once you get whether it's good, bad, then you dig into the reason why. Yeah. Second is industry comparison. So again, if the company's ROC is going at the same way, but you wouldn't know whether it's good or bad unless you compare it with someone else. You need to compare it with the peers, you need to compare with the other industry standard to know whether it is good or bad. Standalone, you cannot draw the conclusion. Yeah. And other than that, you need to consider other things also. Important thing is debt, because in this capital employed, there are all the kind of capital is included. Long term sources of fund, which includes the equity, preference capital, it also includes the debt, right? So you know, when you take a overall conclusion, you also need to know the debt, how much is the debt which is involved in that, right? Because the company ROC may be good, but if the debt portion is increasing year by year, right? So increasing the debt is not a good position in the long run, right? In the long run. So the debt portion also need to be considered. So you analyze the trend, and or fourth is you need to analyze the earning sustainability, like whether the earning is sustainable or no. So actually, when we calculate this EBIT upon capital employed, so when we calculate the EBIT, generally we consider only operating profit, because all our analysis purposes, ideally we should be considering the operating profit, because non-operating incomes are basically one-time income. Okay, so if you want to take any investment decision, you should not consider any non-operating income, because those are one-off items, right? If on that basis you take decision, that may be wrong. So generally we consider not operating profit, I would say operating incomes only, which are from core business activity. Yeah. So you need to consider only operating income. So that's what you need to see, whether those earnings are sustainable for future or no. If you have by mistake calculate the EBIT, taken the EBIT including the non-operating things, non-operating income, then you may draw the wrong conclusion, right? So those all things need to be considered. Also, when you analyze, you need to consider the macroeconomic factor about the inflation and all, right? Those are the basic things that need to be considered, but these are the specific things which you need to keep in mind when you analyze the ROC. ROC, if it is high, that's good. It means the company is efficiently using its capital. If it is low, that may be bad because company may not be efficiently using. Just the normal conclusion, but you need to dig deeper to know if it is low, why, and if it is high, why. Once you know the reason, then only you can draw the conclusion, because sometime if whatever you see may not be the actual thing, there may be certain things behind it which we need to know. Like I mentioned, that they may be investing in a project, but it will earn income from the next year or year after. So for a couple of years we can expect the ROC would be low. All these things, so you need to analyze the trend, industry, consider debt structure, and also always, as I said, in order to analyze the overall things about the company, you cannot rely on one ratio. You need to consider other ratios also. So even in this case also, you need to know the debt equity ratio, you need to know the return on asset or return on equity, to know the overall profitability, yeah, among other things. Yeah, yeah. So that's all about the ROC, what is return on capital employed. So we understood what's its formula. We dig deeper into the formula and its element, and also we see how do we analyze it. So basically, it shows how profitability against the $1 of a company. So if I've invested, or if the company has invested $1 of capital, then how much earnings or return they are getting. If $100 invested, what is the return company is generating? Okay, so it talks about the capital efficiency, and using that, by comparing with the industry or the trend or peers, we can analyze and take a conclusion. Okay, which company is good, which company is not so good. Yeah. So I hope, guys, you might be clear. With this video, you'd be clear about the ROC. In our future videos, we'll discuss about the other important ratios, like return on equity, return on asset, and other things. So if you like my video, please like and subscribe, and please do provide your comments about the content which I am providing. If you have any suggestion, please do write in the comments. So keep watching. Thank you. Bye bye.